Okay, in this video I will talk about company costs. And company costs they occur when in order to generate income. Company costs are you have different types of company costs. There are trading companies, there are production companies, and there are service companies, as we know. They all need to acquire and use productive assets, production factories, in order to produce and supply goods or services for their customers. There are three main groups of productive assets. We have the tangible productive assets, such as goods for resale or raw material, buildings, machinery, fixtures and fittings, and office equipment. Then we have a labor force, sales staff, production staff, and office staff. And then we have service, such as assistants from accountants, lawyers, and advertising agencies. When a company acquires a productive asset, the cost price of this asset will be an expense for the company. In other words, an expense occurs at the moment when a productive asset is delivered by a supplier. This means when the supplier delivers the product, that's when the expenses happen. Then we have the cost. The costs occur at the moment when productive assets are being consumed. In other words, cost constitutes the consumption of productive assets involved in carrying out production and or sales converted into cash. This is when the product is actually being used. Then we have the payments, and the payments, they occur at the moment when companies withdraw funds from their liquid assets in order to overdraft their account and actually pay for the product. An example is in February 2016, companies buy goods costing $20,000 and credit periods of 60 days and been agreed with the supplier. Half of the goods are sold, consumed in March 2016, while the other half are sold in May 2016. The expenses, payment, and cost involved are as follows. You see an expense here in February because that's when they get the product. Then the payment occurs after 60 days, that's in April. And then we see the cost in March and May. We have in business economics, we have fixed cost and we have variable cost. And fixed costs are costs whose total for any given period is directly determined by the size and composition of the sales volume achieved. Anyone wishing to establish a production company needs to build up a certain amount of capacity in terms of premises, machinery, and staff. This must be done before purchasing, production, and sales can be achieved. The maintenance of this capacity costs money, and the money spent generally referred to a company as fixed costs. These are costs that you need in order to keep production running. Cash fixed costs comprise fixed costs involving a payment at the same time as the capacity in question is consumed. A company's rent, salaries, cleaning bills, insurance policies, and office equipment are examples of cash fixed costs. Calculated fixed costs comprise fixed costs involving payments at a different time than the time of the capacity in question. For instance, when a company buys machinery, vehicles, and fixtures and fitting, it pays for these assets immediately and can use them for a number of years. In other words, calculated fixed costs include depreciation on machinery, vehicles, and fixtures and fittings. In terms of fixed costs, we can also get in the situation when you suddenly need a new factory, you suddenly need a new building in order to keep production and in order to actually produce as many products as you're actually able to sell. Therefore, you need to step up production. Step cost is another term. This means that in order to keep production, you need to actually increase your fixed cost. In this example, you see the sales volume per month and you see the number of products. And until 3,000, you see the fixed cost is 200,000. But then after 3,000, you see a situation where 3,001 suddenly you need to increase your fixed cost. This means that the fixed cost per unit will actually increase from 3,000 to 3,001. So the 3,001 is the most expensive one to produce. As we can see here we can see the figure shows that actually when the sales volume increased from 3,000 to 3,001, you see an increase here, and you also see an increase. You also see how the fixed cost per unit is falling, but then it suddenly increases and then it falls again. Step cost constitute the increase in fixed cost arising from an increase in capacity. So every time you increase the capacity, you need to of course also think of, okay, is it this smart in order to actually avoid step cost, unless of course step cost is a mean to actually increase your volume and increase your sale, and thereby at the end actually reaching a higher goal. Step costs are reversible if companies can get rid of them again when the level of activity falls. If this is not possible, they are irreversible. This means that if, of course, they buy a new factory, it would be irreversible. If they rent a new factory facility, it would be reversible, because then they could actually get rid of them again. Then we have the other term, variable cost. And the concept of variable cost, once a company has built up a certain capacity, it can perform an activities, purchase, production, and sale of products. Then you see variable cost, a cost whose total for any given period is directly determined by the size and composition of sales volume achieved. Then you see proportional variable cost increase proportionally as the sales volume increases. The decreasing variable cost changes more slowly than the sales volume, and progressive variable cost changes more quickly than the sales volume. As we see here, we have the three examples. We have proportional, progressive, and decreasing. So we see a situation where it's actually a good thing for the company actually to increase the sales volume. Then we have the total cost, and the total cost, that's the total of fixed cost and variable cost if you add them together. Companies incur both fixed cost and variable cost, and the sum of these fixed cost and variable cost is known as total cost. Then we have the differential cost. Differential cost tells us something about, comprise the average increase or decrease in turnover per unit occurring at the level of total cost when the level of activity is changed by more than 1 unit. There we take the differential cost, we see change in total cost divided by change in sales volume. Then we have the salaries. And salaries, we have wages, salaries to sales staff, other forms of salary. If we take wages, when we use the term wages in this book, we mean the wages paid to employees of production companies who are involved directly in the production of finished goods. Salaries to sales staff, just like wages to production staff, salaries paid to sales staff can be principally also categorized into two types: fixed salary per month and salary dependent on performance. Then we have other forms of salary. Other forms, this could be administrative staff or others, will normally be paid in fixed salary because the work they do is difficult to measure. This salary may be supplemented by a bonus depending on the profit earned by the company during the year. Then we have cost of premises. Cost of premises is always a relatively large item in the accounts, whether a company uses rented premises which is already owned. Then we have sales promotion costs. Sales promotion costs occur with a view to increase sales and the company's product, and include cost of advertisement in print on radio, television, internet, etc. Depreciation and fixed costs. If we take depreciation for any period is the proportion of the cost price of fixed assets deemed to correspond to the depreciation value of such a product. It means that, of course, if you buy a product and you start using it, this means that if you start using a factory or you start using a machine at a factory, then you might have an idea that this will actually this product will be able you will be able to use for 5 years or for 10 years. And then each year you can write some off. This means that you say the annual depreciation, you can calculate it in two ways. You can use the straight line methods, where you take the annual depreciation, take cost price, subtract scrap value. The scrap value is the value that you expect to gain after using it. After the 5 years or 10 years you plan on using it, and then you subtract it with the useful lifetime. Then you have the reducing balance method. The reducing balance method leads to depreciation of fixed assets by a fixed percentage of their current book value each year. You take annual depreciation initial book value multiplied by depreciation percentage and subtracted by 100. In this case, it will not be the same depreciation each year because, of course, the initial book value multiplied depreciation percentage and so on will change. Reducing balance depreciation means that the annual depreciation deducted for each year of an asset's lifetime grows smaller each year. Depreciation is a fixed cost because it's not influenced by the sales volume. If we take the profit and loss account and we use the contribution method, then we say, okay, we have the net turnover and then we subtract the variable cost, and then we get the contribution margin. Contribution margin. Then if we take the contribution margin, subtract sales promotion costs, we get the marketing contribution. In this case, we can see an example of a profit and loss account of 2016 with the net turnover subtracted variable cost, the contribution margin, subtract the sales promotion cost, and then we have the marketing contribution. Then we subtract cash fixed costs, and then we have profit before depreciation. Then we subtract depreciation, profit before interest, and then we have interest costs, and then we have profit for the year. Then we can see that yes, for the trading company we have the gross profit and contribution margin. So the gross profit, cost of sales, gross profit, then other variable cost, contribution margin minus sales promotion cost. Then at the end we also have this the profit of the year.